Hi everyone, my name is Jay. Thank you again for joining us in another episode of Professors in Conversation. Today we have with us Dean Yadav. She's an Associate Dean and the Director of Culture and Community. She teaches Securities Regulation and a cryptocurrency seminar. Welcome, Dean Yadav.
Thank you so much, Jay. It's such a pleasure to be with you today. And I should say that Jay has been one of my students and one of my most awesome students, whom I completely loved having in class. So it's great to have these conversations with you, Jay.
Thank you for your kind words. Today we're going to talk about U.S. Treasuries and stablecoins. I had a chance to look at your recent paper that kind of talks about what Treasuries are and what stablecoins are, and kind of the risks associated with when these two currencies mix.
Yeah.
So for our viewers who may not know, can we start off by kind of talking about what is a Treasury?
Yeah. Treasury is like the building blocks of life, I like to say. Watson and Crick and the whole DNA thing. Totally second order to Treasuries. What we have with Treasuries is the U.S. government bond. This is the bond that the U.S. issues. So it's like a little token, an IOU that the U.S. issues when people lend it money. And it turns out that the U.S. does borrow fairly significant amounts of money in order to keep its markets running, its society running, to build the bridges, to fund the army, to do every little thing that you look and see around you. But in addition to making sure that the U.S. government is able to borrow to fund its needs, the U.S. Treasury market does a whole lot else. U.S. government bonds are the safest securities assets anywhere in the world. These are the quintessential risk-free asset. This is the asset that everybody wants to keep themselves safe from all sorts of disasters, whether it be the pando, whether it be some kind of crazy, natural disaster, or just to make sure that their super risky portfolio is hedged with something really safe. So U.S. government bonds are used by pretty much any and all kind of investor. So we have banks, we have mutual funds, we have hedge funds, we have everyday people that buy U.S. Treasuries in order to keep their sort of everyday lives functioning and their financial lives going. So one, it allows the U.S. government to borrow to fund its needs. We have a market today in which we have approximately $30 trillion of marketable debt. So one, it allows us to borrow. Number two is the risk-free asset that drives the global economy. So that's why the U.S. government bond is the center of life.
Yeah, I think, if I'm not mistaken, it's also used for collateral in the institutional world as
Absolutely.
Well. Right.
So as you can imagine, so there are two types of things to think about here. One, we have a super safe risk-free asset that is on the books of the U.S. government. The prevailing theory, of course, is that the U.S. government will never default, right? So we have a super powerful economy. We have, just a huge financial market. And so the U.S. Treasury bond is super, super safe. Now, there's another asset that's on the books of the U.S. government that's also super, super safe, and that's U.S. public debt, which is cash. That is actual dollars. That is the other kind of super safe debt that the U.S. issues, which is just plain physical dollar cash. Now, here's the thing. People can afford to keep cash all the time to make sure that they can get credit, to use that debt as security to unlock cash. Cash is unwieldy, it's expensive to get and keep. So in order to have really robust portfolios of really safe assets, financial institutions tend to keep two types of super safe debt. One, U.S. Treasuries, and two, cash. So when you look at cash, you look at Treasuries, they tend to provide the assets that the entire world uses to collateralize, meaning to secure in order to get other kinds of assets in return. Now, the best part about using super safe cash and Treasuries is that you have to pay the lowest amount. You get the highest amount of assets that you, in return for giving up $100 of Treasuries for cash, because they're so safe. Everyone trusts them.
Now, that's the fiat system, but I want to transition to the crypto side, which is one of your expertise. Could you explain to us what a stablecoin is?
Yeah, let's talk about stablecoins. Now, most people would be super familiar with Bitcoin, right? So this is the thing that shook the world in 2009, this Bitcoin white paper that comes out that imagines a world in which people are able to send value to one another peer-to-peer without governments and banks getting in between. So it's a way in which networks are all, everyone's collaborating in one single network. They're all deciding together by consensus which transactions should be in or out. They're providing safety to the network as a community rather than relying on any single bank or state. And so that's an example of a decentralized network of which Bitcoin is the native coin. It's the native coin that rewards this community of doers that create this infrastructure for moving value and information. So that is Bitcoin. Now, stablecoins are not Bitcoin. Okay, so one thing that everybody knows is that Bitcoin fluctuates a lot in value. It was originally seen, as we just talked about, as a payment system, but it hasn't functioned as a payment system. It's volatile, the blockchain is kind of slow, often quite expensive to use. So in like 2014, the crypto economy needed something that functioned as a payments tool, as a way to reference an actual unit of account, store of value, and medium of exchange. That's a classic definition of money, right? That's something that can measure what you're buying and selling in a very stable and liquid way. Stablecoins were born. What stablecoins are a digitally issued token, as in a token that's issued on a blockchain that is always pegged one-to-one with some kind of fiat currency, usually the dollar. 99% of all stablecoins out there are pegged one token to $1. And that's kind of awesome. What this means is that you have tokens out there that reference $1 to one token. They're issued on these super international blockchains. And they are able to transmit $1 worth of value super fast, super cheap, super internationally across these global blockchains. Now, the big difference between a stablecoin, most stablecoins, and Bitcoin is that stablecoins are centralized. There's an issuer behind these promises that one token will be equal to $1. So there's, big time companies that are backing up these promises to say, look, we have the assets, cash and treasuries, right, that are backing up our promise that every single token is worth $1. And so what we have now since this industry started 2017, 2019, there were $1 billion worth of stable coins outstanding. Not a whole lot. Today, 2025, it's 300 billion as of last month, October. I don't even know what month or year it is anymore, to be perfectly honest with you. But as of October, we have $300 billion worth of stable coins. The Treasury Secretary is projecting that this outstanding volume will grow enormously to something like $4 trillion potentially by 2030, and really forwarding the stablecoin concept, the tech, the reach as the way for the global economy to become even more dollarized, right? For the dollar's ability to propagate and be used to become supercharged by virtue of these stablecoins. So the big companies out there are Tether, that's the biggest. I can't remember exactly, but I think we're looking at something 180 billion outstanding. Wow. And then we have Circle, which is a publicly traded company, has approximately, I think, $80 billion worth of stablecoins outstanding. PayPal's another one with PYUSD. I can't remember exactly, but quite a lot outstanding. Wow. Yeah.
So as kind of stablecoins have grown in terms of their presence in the financial system, the crypto side of stablecoins are more reliant on U.S. Treasuries. And in my mind, there's kind of this bridge between the fiat system and the crypto currency ecosystem. And with that, in your paper, you talk about the risks that are associated with it. And I've kind of broken down in my mind into kind of 4 buckets of risk: liquidity risk, interest rate risk, credit risk, and duration risk. Could we just kind of go one by one?
Jay's being fancy.
Could we kind of go one by one, and you can kind of tell our viewers a little bit about what risks are associated with this kind of treasuries as being an underlying asset that backs stable coins. Yeah. So let's start with liquidity risk.
Yeah, great. I think that's for me the big risk, right? Which is that we have these stable coins. They are, they're out and about. They are powering or promising to power the global payments marketplace. People love them. They send money super quick, super cheap, internationally, and that beats often the kind of bank-based dollar movement system, right? So if you want to send international dollar transfer, that's going to cost you a ton of money. It's maybe $40 in fees, $15 to receive it. So if you think about folks who are here and maybe sending money abroad, they have to pay that much money to send money abroad. Instead, what you see are people using stablecoins to do that job. And in emerging economies, stablecoins have become a big time use case for international dollar transfers as well as for dollar savings, right? Instead of saving in their home currency, which might be unstable or whatever, they save in dollars. So the point here is that there are lots of people now already who are relying on stablecoins to function as money, right? To function as safely, as fully as possible. And this entire system rests on having assets that back it up, that are safe and super liquid, that the issuer, Circle, Tether, whatever, can immediately sell, get the cash, and then pay out to the customers who are holding and relying on these stablecoins as payments tech. So one of the big passion projects that I have is looking obviously at treasury markets and also at crypto. So marrying these two things, we have an intersection where stablecoins are relying on US treasuries for their entire being, for their function, in order to propagate. Now, going back to the beginning of our conversation, why treasuries are so awesome, two things. One, traditionally, they've been super safe, no credit risk, at least in theory, no credit risk. The second reason is that one can always buy and sell treasuries in a highly liquid, predictable way. I can always go to you, Jay, and say, hey, I'm just going to sell it to you. There'll be a market. It's going to be available. I can always transact. That makes treasuries really powerful. But what's happened over the last 10 years, maybe 10 years now, is that the US Treasury market has been suffering from a series of liquidity crunches, series of factors that have made the market much less able to take high volumes of treasuries and to buy and sell them fluidly and at stable prices. A couple of reasons have been driving that. One, the supply of US treasuries has expanded enormously. August 2008, we had approximately, I think, $5 trillion worth of treasuries outstanding. Today, it's 30, right? Banks who are intermediating the system, who are working as providers of the buying and selling, who are lubricating the wheels of treasuries buying and selling, they're just running out of room on their balance sheet to do that job. In addition, post Dodd-Frank, there have been lots and lots of measures to make banks safer. Protect their balance sheets, keep assets on their balance sheets to safeguard those balance sheets. What that has meant, though, is that in the context of making markets for treasuries, they've been quite constrained. So what one sees is that, one, supply of treasuries has increased. These banks are having kind of really tight balance sheets. Number three, they're facing a lot of competition from these high-frequency traders. That are these super fast, really nimble, kind of hyper-efficient trading firms that are much smaller, much more competitive, much less capitalized than traditional banks. Now, this competition means that banks have to fight harder. It also means that whenever there's a problem, they have every incentive just to leave, save themselves the profit that they are making, saves themselves the risk of losing. Same with HFT traders. They don't have the balance sheets to stay in this market. A market as big as the treasuries market, a market as systemic as the treasuries market. And the last thing to say here is that the liquidity in this market tends to get a little testy in situations when we need it the most, right? So when we talked about at the very start of the conversation, what do we use treasuries for? We use treasuries to keep ourselves safe. During the pandemic, big natural disaster, some crazy international event, we grab for treasuries. That is the exact time when it becomes high pressure, when there might be some losses, when there might be some selling pressure or buying pressure on that market, as there was in 2020. And these market makers, they want to leave. And so the liquidity in this market can dry up. Now, why that's relevant for stablecoins is that, these are massive payment systems now that are going to need potentially, if they have a crisis, to sell large amounts of treasuries. What happens then? Does the market have the capacity to absorb that demand? Does the market have the capacity to buy and sell and transact in these treasuries super fluidly to help these stablecoins act as the money system that they are out there trying to be? So we have a market that we know, everybody knows this is not a mystery, has well-known problems, cracks in the foundation. But now we have a brand new payment system, the US dollar's kind of future, that is now relying on this cracking system to supply it with the safe assets that will deliver that moneyness in stablecoins. So the liquidity issue is a big thing.
Let's move on to the second kind of bucket of risk that I have in mind, which is the interest rates. I know that the interest rate environment now is higher than what it has been historically, obviously, like for the past couple of decades. And how does that factor into kind of the stablecoin operations?
It's a great question. There's one big way, which is that stablecoin companies, when they have a bunch of treasuries, they're actually earning yield on their treasuries, right? So it helps them in many ways if the rates are high. So you see that in Circle's IPO disclosures. If you look at the S1, like, you know, a good deal of income is coming from being able to invest in these treasuries and get returns from that. So when we are thinking about, you know, lowering rates to maybe help reduce the mortgage rates and so on, for the companies that are relying on treasuries to generate passive, you know, income, that is actually a little bit of a danger, which means that, you know, some of the gains that they're making from providing this service as a payment services provider can potentially erode if the if the prevailing interest rate environment becomes less favorable to them. So, you know, that can mean potentially, as a law professor, you have to think like this, which is that will such companies start taking risks elsewhere? Like, will they try and put, you know, some of their capital into riskier but still safe, you know, investments in order to get that little bit extra yield to support the infrastructure that they're providing? So, you know, those are potential considerations to think about. On the other side of it, which is that, you know, what are the treasuries that are actually being used as collateral here? This is a super interesting development. The treasuries that are most kind of cool and awesome and gorgeous to use as collateral, like the super sellable ones, are the very short-term treasuries, right? So-called T-bills, right? These are treasuries that have a maturity of like, you know, 90 days, a month, whatever. And these are the treasuries that tend to be the backbone of stablecoin reserves. So Tether, for example, reported that like 66%, I believe, was like of its reserves were going to be in short-term treasury bills. Now, that's kind of interesting for us as a fiscal power, which is that if you have these stablecoins out there that are going to power the next generation of dollar payments, then they need to devour, they need to like eat and consume short-term treasuries to make that happen. Now, Secretary Belton is projecting $4 trillion worth of stablecoin outstanding by 2030 potentially. Now, that's going to need us to produce as a country short-term treasuries to fuel that growth. So traditionally, we've had, you know, 20% of our issuance traditionally, for various conventional reasons, whatever, in short duration debt. This is debt that's going to roll over every like 90 something days. Now, the question is, are we going to have to increase that to meet the demand from stablecoin issuers? Now, that's not exactly answering your question on interest rates, but it does, because, you know, short-term treasuries are cheaper, as you can understand.
Yeah.
However, they do create interest rate risk for the US, because when it comes time to roll over the next time, like 90 days or whatever, a month, the rates might have to go up, right? You might have to like pay a little bit more. Like, so that rollover risk, that interest rate risk, suddenly we're having to internalize some of that at the back end, because now we really have to think about issuing enough debt that stablecoin issuers can then use to power this new payments economy.
This kind of flows really nicely into what I had in my mind, duration risk from the U.S. government's perspective. If the U.S. has to issue more short-term issuance, in my mind, it impacts like infrastructure projects and like how they kind of plan financially for that, right?
Absolutely. I mean, look, we have a system whereby we balance long and short duration so that we can have projects that go for 30 years, 20 years. You know, that's the goal here, that we can borrow with some certainty, that we can pay a certain amount of, you know, interest back and make projects and make plans that can build our roads, build our AI infrastructure, like build our quantum resistance, like do really big projects that you send people to like Mars or build the Starship Enterprise, which I would personally volunteer to go on as soon as it is ready. You know, like that's what we need, and that requires long-term investment. But the question becomes, if our percentage of issuance gets focused on the short term, how do we manage that longer duration risk? Now, what you're seeing today is a very interesting phenomenon whereby the longer duration treasuries are, you know, becoming quite expensive, more expensive than usual. The gap between the 10-year and the 30-year in terms of like the rates, the 30-year is, you know, ticking upwards. You know, it's becoming more expensive. than it traditionally has been, that gap between 10 and 30 years. That gap is actually becoming a little bit more than what we're used to, because people are pricing in the likelihood of inflation. They're pricing in our fiscal environment where we borrowed a lot. Can we have the GDP to pull it off? So, what one is seeing is that this little gap is opening up. 30-year is becoming much more expensive than what we're really expecting or used to. And that means that we're going to shy away from that potentially. It's just expensive. If that's the case, we have these big like ravenous consumers of short-term debt, stable coins, as well as other actors. Let's just issue short-term, right? Because we're going to meet our fiscal needs. We're going to do it relatively predictably at the short-term level, but what happens at the longer end? And that's something that we really have to think about. And a lot of investors, they also enjoy having some longer-term debt on their books, as you can imagine, to balance out their portfolios. What's going to happen to that when the U.S. government is maybe less interested or engaged or enthusiastic about issuing lots of debt at the longer end?
That's really interesting. The last bucket of risk that I have in my mind is credit risk, and you kind of briefly touched on how theoretically treasuries don't have credit risk, but in your paper you talk about how there's still some risk associated with them. Can you tell us a little bit about that?
Yeah, this is probably like the most out there kind of discussion, because we're just never thinking of the U.S. as a debtor with any kind of credit risk attached to it. The thought should make everybody shudder, and it does, right? Like the market becomes completely bananas when you highlight the potential for a U.S., let's not call it default, but definitely some shakiness. However, we're definitely not helping ourselves here. In particular, aspects of our political economy has given a lot of cause for pause to investors, particularly during debt ceiling fights. So they have really gone to the brink in some cases, and what one has seen is, an increase in the yields of the bills that are due on around the time when the debt ceiling is going to hit. So you start to see investors pricing in that absolute nightmare scenario that somehow we're not going to have enough money to pay our debt. Now, the crazy thing is, of course, that every single major credit rating agency has downgraded us. We no longer have a stellar AAA rating. So Moody's was the last one to do it. Standard & Poor's, Fitch have all done it. And in addition, U.S. Treasury debt does have these contracts that trade on it called credit default swaps, right? Credit default swaps are contracts that pay out when some kind of debt is in default. If we don't default, why do we have these stupid contracts trading on our debt, right? Obviously the scenario is unthinkable, should be and probably is, but nevertheless we've kind of walked ourselves into these political fights that have given investors some cause for worry, right? That have given investors some feeling that maybe we're just playing fast and loose with our incredible superpower that is the U.S. Treasury market. The last thing to mention here is that there have been some conversations about restructuring the enormous pile of debt that we have. So the Mar-a-Lago Accords, for example, they're part of the conversation that has occurred in this administration about maybe thinking through how to renegotiate some of the debt that we have with our big investors. Now, again, that is something that will give the market a lot to think about. Does this constitute a default potentially down the line? And if that's the case, good luck to the global economy, thoughts and prayers, because it's just about the most intense and unthinkable and unknowable set of doomsday scenarios that the market can ever contemplate. The U.S. Treasury is the anchor point for the global financial system. To imagine anything else is a different world.
As kind of stable coins become a bigger part of our financial system, in your paper you kind of offer some policy considerations for policymakers to kind of consider when kind of integrating this new stablecoin technology into our fiat currency system. Could you tell us a few kind of points that you want to share with us?
Yeah, look, I think the main thing to think about is that we've been kind of slow to connect the old fuddy-duddy treasury market with this brand new shiny stablecoin system. We've just assumed, like we always assume, that the US Treasury market will inevitably perform. The US Treasury market, as you mentioned, Jay, is the source of collateral for almost $4 trillion worth of debt outstanding in the financial lending market on any given day, the repo market. It is the basis for regulatory compliance when every financial institution today pretty much has to keep treasuries to keep itself safe. That's mandated by legislation, Dodd-Frank Act, post-financial crisis. Everybody has to keep treasuries because we just assume they're going to perform. So the idea that stablecoins now have to keep treasuries to maintain their moneyness is completely in line with how we think about regulatory policy in this context, that treasuries will always perform. Now, I think policymakers have to give really good thought to thinking through ways in which to support a scenario in which treasury market seize up, the liquidity short, when the primary dealers, the big banks, just don't have the balance sheet capacity to absorb the failure of one, maybe two major stablecoin issuers, or even like large, like a potential like liquidity crisis that might occur for them. This is not unthinkable. When Silicon Valley Bank collapsed, Circle, the big stablecoin issuer, broke its peg over the weekend. I believe it fell to something like 88 cents per token. And so in that context, the treasury market needs to be ready. The liquidity providers need to be ready. There needs to be some backstop in the event that some stablecoin issuer is going to have trouble accessing that liquidity. The big issue now is that the stablecoin issuers are at this juncture where they're private enterprises. They are clearly, driven by their own organizational needs and business models and are competitive. But equally, they're now fulfilling a pretty big public policy goal, which is propagating the US dollar around the world, operating a payment system that people everywhere are relying on, and increasingly people with very little economic slack in countries that are quite vulnerable in terms of their economic system. So the question becomes, do we have policy measures in place ex ante? For example, a potential facility, a liquidity facility that stablecoin issuers might be able to access if liquidity is tight, making sure that maybe they pay for it in advance, making sure that the market makers that are involved in supplying liquidity maybe have something stored away in the event there's a stablecoin and treasury liquidity issue that intersects. More than anything, we need to make sure that the back office systems are also integrated. So when you want to sell a treasury, that the cash comes out very quickly. That can be used by the issuer to pay out on its customers. Now that's important because we're talking about money here. Everyone expects money in their hands when they need it. Yeah. And so you can't have these super clunky back offices that are going to take like 1 business day, 2 business days more to get the money out. So policymakers, I think, just need to give a lot of thought to integrating these two ecosystems, not assuming just that treasuries are going to perform and having in place measures that will, click in and, pump in as soon as there's a crisis, and that hopefully will be paid up in advance by those looking to use it. Otherwise, I think we're walking into a scenario where we're hoping for the best, but we haven't prepared for the worst.
Well, that's awesome. Dean Yadav, faculty members at Vanderbilt Law School are always working on cutting-edge research. What are you currently working on?
Well, just making sure that I can have the latest sci-fi Netflix series on. I mean, I guess that's that. So, anyway, outside of that, I'm working on a couple of projects. First and foremost, I'm working on more stablecoin work with 2 wonderful co-authors, Chris Odenet and Andrea Tosato, and we're looking at the ways in which stablecoin contracts affect how their redemption quality works. So we're sort of thinking through some of the sort of nitty-gritty of looking at stablecoin contracts and how that makes sure that stablecoins can actually act as fully money as possible. So that's one strand of research. In addition, I'm super obsessed with market structure, just like you, Jay. And so I'm doing another co-authored piece with my friend Jonathan Brogard, and we're looking at how the big market makers today function and how big is big, right? So some of them, as you know, like Citadel and Jane Street and others, are super present in today's market.
Right.
And so we're just talking through the impact of having market makers today that are really big and dominant. And what are some of the pros and cons of that for market quality? So that paper is actually like almost ready to put out, and we're really excited about that.
I look forward to reading it. It sounds really
You
interesting.
will be the first person I send it to, knowing exactly how geeky you are. So you will be on the immediate circulation list for that paper.
Sounds good. Well, Dean Yadav, thank you so much for speaking with me today. And thank you to our viewers for tuning in to another episode of Professors in Conversation. I hope you join us next time.
Thank you so much. Thank you, Jay.